perfect storm for most producers in those great yields and great prices, which don't always coincide together. So you can see that, and I went back farther than 10 years, and I know when I told Ryan I was going to do this, I was going to do 10 years. But I went back on a lot of these slides prior to 2008, which is when we started, 2007, 2008, we thought were fantastic, amazing years that we'd never see anything like that again. Of course, it got better up into 11 and 12. And then we saw, a big long-term decline in profitability. And so I think I went back farther thinking that there's some things that I think we can learn as we're sitting in this second year of really good profitability and what that might look out as we look forward. So I always like to dig deeper than average, because average doesn't really tell us much other than that middle number. It doesn't tell us the whole story. Excuse me. So we did have a net income range of over $3.4 million. That's the largest range in profitability that we've ever seen. Lots of big numbers on both sides of that equation. So we did only see just about 6% of the farms saw negative income. That's a really low number. If we go back into the 2011, 2012 periods, where there was times maybe in those 2 years when we actually had no farms with negative incomes. But it takes that kind of very rare year to where we wouldn't have any farms with negative income. And I did put in back in 2015, which would have been the low year on that trend line that we were looking at a minute ago. 44% of the farms that we worked with had net losses that year. So again, just to kind of give some perspective on what that means, that we had a very small number of operations. Like I mentioned, our liquidity is improving. Our recovery from working capital gross revenues, which I'll dig into a little bit more, is back to 2013 levels. And again, that's a great thing as we move into more uncertainty as we look forward. And then all types of farms saw that increasing income level. So it's not just crop farms, not just beef farms, which we saw a lot over the last 5 or 6 years, where one would have a good year and the other would have a bad year. But in 21 as well as 20, all types of farms certainly did well. When I break that net income trend down by profitability group, we can look at these trend lines. So again, this is the high profit third each year, the low profit third each year, and then the average each year. And I only went back 5 years on this one because I didn't index it. So these are actual numbers, but I think you can still see that separation in how we have that top third of our producers actually averaged over $1 million in net farm income. So we have certainly a segment of the groups that we work with that did very, very well, making even the average number not look so good. And then some of those operations that, again, that low profit third average just a little, maybe like 500 or 50,000, somewhere in there. So some of those operations weren't quite as profitable, but still doing well. If we look again at crop and livestock operations, the beef line is a little off because there's a couple of years when I just don't have enough farms that would get 70% of their income just from beef alone. But if we look at the crop and beef, that segment did better than the crop operations. Again, just a good year in 21 for a lot of those livestock operations. All right, well, let's look a little bit about family living and taxes. This chart just kind of blows my mind. 10 years, we've really seen very little change in family living and taxes. That's a good thing, because when from 2008 to 2012, we saw that number climbing so rapidly. But this continues to be a nice stagnant number. So certainly a good thing from a trend line perspective, but it is still 100,000-ish every year for family living, plus another 20,000 for income taxes. So if I put that here, like I said, 21 was 92, so we were just a little under that 100. But we had about 28,000 in taxes, almost 30. And then we also have other things that don't go into that family living number, things like vehicle purchases, non-farm real estate, non-farm savings. In total, last year we saw about 163,000 go out of off into non-farm categories. Now, again, some of those might be asset purchases, but still a lot of money going from the farm side to the non-farm side to cover those expenses. And I put 2012 in there again. That, it's 10 years ago, but it's also just kind of that last kind of big peak in profitability that we saw. And you can see that the taxes at that time were higher, which makes sense because 2012 was the 5th year of high profitability, not the 2nd year. So those things tend to lag just a little bit as we do what we can to defer those taxes. But I think those non-farm capital purchases, and non-farm real estate taxes or real estate purchases in those years really starts to show up of what added to some of those extra things. We saw a lot of houses being built, a lot of the what some people would consider to be the toys, the campers, the boats, those kinds of things being purchased at that time, which in hindsight ended up some of them not being the best decision since profitability fell off so quickly after that. One other thing I'd like to point out, just to kind of give people perspective, because to live on $92,000 is not like having a $92,000 a year wage. Okay, so I calculated backwards, and it's not a perfect calculation, but I put 5% in retirement and $1,000 a month towards principal payments, and calculated what the income taxes would need to be to get a net check of about 92,000, and you need a salary of about 160,000. So this year, obviously, our net farm income far exceeded that, but on average, we have not seen net farm incomes at that $160,000 mark consistently in order to support the family living that has been steady and consistent there. And so people ask us, so why do we care? But it comes down to, if you're spending more than you're making, we're having to use debt to service that. And, I just ran, some really simple numbers of just seeing that shortage year after year and how that snowballs into additional debt. And this might look like farm debt because it might be the operating note being used to cover these expenses. But it's still going to be expenses that are building. All right. So all of that leads us to a net worth change. Again, these numbers just kind of blow my mind a little bit. Again, we just haven't seen numbers like this in so long. And even in 2011, they weren't this big, even though indexed, it would be pretty close to this. But again, net farm income just over $500,000. We did have 42,000 of non-farm income. Saw that 83,000 of family living and owner withdrawals there. That number is different than the 92,000 we were talking about before, because this one includes all the operations, not just those that give us detailed family living. Same thing with the income tax number. But we saw average net worth increase almost a little over $500,000, which again was certainly a healthy thing, healthy balance sheet adjustment. So this is the net worth change trend. Again, I went back to 2008. So this is not the trend of net worth, but the trend of net worth change. So we actually did see a couple of years where we had net worth losses in 15 and 16. And saw that rebound and improve again. And I think one thing that's important, and I'm just going to flip to the next slide, because I put this trend line on there that, we're sitting over that 14-year time period of about $150,000 of net worth added a year. That would be great if we could just consistently have that kind of net worth change. We just don't have that. So what we need to make sure that we pay attention to is in those years when we're adding more net worth than that we're putting the operation in a good position to withstand those years when it's not going to be there. Because unfortunately, I think, this kind of a trend line is probably more realistic than having a nice steady trend increase just for the nature of the business that we all are in. So, but still good positive news, lots of balance sheet improvement over the last year. So let's take a little bit look about some of this, dive a little deeper into some of this debt information. So we talk about a lot about farm ratios. Again, if you're not familiar with a lot of that conversation, we tend to talk about them in terms of red light, yellow light, and green light. So green light being a strong ratio, yellow light being a caution, and red being a vulnerable position. So we'll see different numbers from different organizations. Different economists have different opinions about what these ratios exactly should be. So don't get hung up if my numbers are a little bit different than what you're used to seeing. But we're going to talk about liquidity first. So liquidity is those current assets and current liabilities, stuff that you're going to sell in the next 12 months and stuff that you're going to pay in the next 12 months. I always like to step back and think about liquidity kind of like your heart rate or your blood pressure. Those things are going to change hourly, and liquidity ratios can change that quickly as well. So it's important to watch them and monitor them because they're certainly a sign of financial health. But it's also important to remember that it might look bad for a short time, but maybe isn't the end of the operation either. So when we get into liquidity, there's actually 3 liquidity ratios, but we're just going to look at one, but it's based off of another. So working capital is current assets minus current liabilities. It shows how much cushion you have left over. It's not a great comparative measure because the size, how much working capital you need depends on the size of your operation. So we look at working capital to gross revenues so that we can compare farms of different sizes. And this ratio has been around since I think about 2008, something like that. And again, that was when profitability started really going up. So it's been hard to nail down exactly what the right number should be here. I've got 33% is green. There are some economists who think 25% is enough. Some think 40% needs to be 40%. Others say that when things are tight and times are tough, they should be 40%. And when things are good, you can go to 25%. So it maybe is even within the general economy that number could change. I went ahead and left this at 33%. So that's that line across the middle. And then the bars are the average again. So like I said, I mentioned that this number has really rebounded, and there's been a lot of liquidity repair in the last 2 years. And you can see that on this chart. But still looking back into 2012, we were over 50%. So we're not back to those numbers. We're still under that. We're just recovered to a point about where 2013 was. So good news. But if we're looking at another long-term downturn of the economy of that 15 to 19 timeframe, it would be better if we were starting at a 50% rather than a 42%. Again, I'd like to dig a little deeper into that. So I went through, and this time I used 25. So again, sometimes I can be confusing on which number that is, but I've been watching this pie chart for probably 6 or 7 years, and this is by far the best looking one I've seen. With 75% of the operations that we work with sitting with at least 25% working capital gross revenue. Only 9% of the farms that we work with have negative working capital, and 13 fall under that 10% range. And so, like I said, this one looks really good. To trend it out, we can look at it this way. So again, same concept as that pie chart, but now in bars. So again, 10 years here, you can see how in 2012 that the number that were red was pretty small, even smaller than what we've got today. But how quickly that red grew and started to come back. And one of the things that's hard to look at these trend lines and fully understand is that not all of that improvement was due to profitability. Some of that improvement was just a lot of refinancing that happened in especially 15 through 17, maybe even 18, where operating debt was moved into a long-term position on an equipment note or a land note to improve liquidity. So that would have caused somebody that was in the red to move into the green zone. And so there was a lot of that happening in those timeframes, and we still saw increases in the number of farms that would have been considered in the red zone. And so it's helpful to see that trend move up. The other thing I noticed when I was looking at this chart was how much that dark green, which I didn't put on there, but that dark green doesn't change very much. And those are operations with 80% working capital gross revenues. And so that basically those operations are not really needing a bank much at all, maybe just short-term operating financing, but they're mostly covering their own needs. I do have this back to 2008. It's a cluttered looking chart, but again, you can see that where we're sitting now in 21 is probably a little better than where the operations were in 2008. Again, you can watch that yellow kind of move up and shrink a little bit into 11 and 12, where we saw our best looking balance sheets. But I think the thing that we can learn again is how quickly we move from that place where we're at in 11 and 12 to where we were in 15 and 16. And so making good decisions as we move out of this high profit time period and into times when margins might be tighter, making sure that we're not overextending our lending, things like that. So I see a question here. With 500,000 in net farm income, it seems that income and self-employment taxes will be higher. So, and the question is it due to some carryover inventory or catch up with people later? So that's the taxes that were paid in 21. So it's really 2020's tax for most operations. And so, yeah, I think just like we saw in 2012, that number be 48,000. And actually, I'm just going to flip back because I think I can show that answer better in a picture. So here in 12, 13, and even 14, after profitability had dropped, the taxes were still higher because we tend to push and defer as long as we can. In 2012 and 2013, it was getting hard to push and defer any more than we could. But that's the actual cash paid that year. So even in 14, when profitability was down, income taxes remained high. So I would expect income taxes to increase again over the next couple of years. And I have a few thoughts here a little bit later on taxes. So thanks for that question. All right. So again, working capital, again, if you work with a lender, they're going to talk about working capital and liquidity and those kinds of things a lot, because it really tells us a lot about how the operation is feeling. I always say that when I go and sit at a kitchen table, I can tell how they're feeling or how their liquidity is by how the operator is feeling. Because if the cash flow is tight, if they're up against an operating limit, if there's nothing in the checking account, it doesn't feel good. And that's the liquidity talking. And so we want to make sure that we have enough working capital and that there's enough there to make those bills pay. Because if you think about things, we talk about working capital's current assets and current liabilities. Well, there's expenses like income taxes and family living, unexpected expenses, those kinds of things that are not in that calculation. So we need that working capital to be able to cover those kinds of things as well. If not, you're going to have to borrow money to make those things happen. And that puts us back in that cycle of continually adding debt. Okay, so that's liquidity. Solvency then is a little bit more, it looks at the whole balance sheet, looking at total farm assets and total farm liabilities. And if we go back to my health analogy, if liquidity is like your heart rate and your blood pressure, solvency is more like your cholesterol and your weight, where also important, but harder to move. So we don't see the rapid changes in the solvency ratios the way we see it in debt to asset for most operations. Again, a young beginning farmer that's got $100,000 worth of assets and $80,000 worth of debt can make their debt to asset ratio move quickly. Much more quickly than a guy who's got 20 million of assets and 10 million of debt. That's going to take, those numbers are just bigger. It's going to take, it's harder to move those numbers. So debt to asset, we look at total farm debt and total farm assets, and it's always a hard one, or one that we need to be careful on comparing, because if you're using total debt and total assets and including non-farm assets and debt, that's going to be a different number than the number that we're putting out here. So pay attention to that as you're looking at your own numbers. It's also important that we're valuing assets the same way. If you're valuing land at its highest and best use, so what it could sell for tomorrow, your debt to asset ratio is probably going to be lower than ours, where we're using, not cost value, but also probably not the full market value of that asset either, so that it is something that we wouldn't have to change And so how we value assets also can make a difference in this ratio. Okay, so here's our trend line on debt to asset ratio. So we like to see that under 30%, which is that black line. 18 and 19, we actually crept over that just at 31%. Again, in all the things that have happened in the last 10 years, the debt to asset ratio has ranged 6%. It's not a huge difference in that. And so I think that's, again, just shows that that difference between that and liquidity. But it's super positive that we've brought that down to 26%. Certainly adding $500,000 of equity is going to move a lot of balance sheets. So again, if we dig a little deeper, same thought process behind my current or the working capital to gross revenues slide. So we're just looking at those that are in a good position, those that are in a vulnerable position, and those that are in a position where we would be concerned. Again, I went back to 2008, so stretch this one out a little bit longer just so we can kind of see that ebb and flow. Don't quite see it move quite as quickly, but looking at how few operations would have been above 60% debt to asset ratio in 2011, we still did see a lot of operations move into that zone by 2017. So even though we've gotten quite a few operations out of that in 21, they're sitting close enough to where they could move into that range pretty quickly. So, and again, the number that are in the green just doesn't change as much as the number that are in the red. All right. Another just a quick thought process as we're talking about total debt. I always like to think about the snowball effect. And again, this comes back to a tax planning strategy. And this one, we probably could spend a whole time slot on this concept. So I'm going to go through it kind of quickly, but really I'm going to let's go through a little deeper. So first year, we've got it as 2020. Doesn't matter what year it is. You made 50,000, but you're only recognizing 35,000 on your tax return. That means that there had to be 15,000 of inventory that wasn't sold, or $15,000 worth of prepaids to get your income from 50 down to 35, right? So we're going to watch our carryover inventory down the bottom line. All right, but you spent 40,000 on family living that year, but you only recognized 35. So just from a simple cash balance sheet, the checking account, if you spent 40, but we only have 35,000 of farm income, and assuming there's no non-farm income, we had to borrow 5,000. Right, so no big deal. Again, on your balance sheet, you've got 15,000 of current assets, 5,000 of current liabilities. So you're sitting in a good financial position, not a problem. Okay, but what happens the next year? You make 75, still only want to recognize 35, so we have to add 40,000 to the 15 that we already carried into this year. Spending 45,000 and still only recognizing 35. Now our operating note's 15. It doesn't take long for those kinds of things to happen before we've got $100,000 operating note and $250,000 carried over, right? And so those things just continue to build, just like a snowball rolling down a hill, right? And at some point, we have to recognize that $255,000 worth of income on the tax return. The only way to get out of that is to die as an active farmer. And so we don't like that as the only option. So it's something to certainly pay attention to as we're pushing these high income years down the road, that it builds debt as well as a tax problem. Just to show you that the Nebraska data actually follows this. So this is the breakdown of our current assets. Again, just went back 10 years to 2012, which was the previous high year that this was the largest. But at the end of 21, we had on average $870,000 worth of crop and feeder livestock inventory. So again, that stuff that's been pushed into the next year has not been recognized from tax purposes. Prepaids were also at an all-time high of 109,000. Had about $33,000 worth of accounts receivable, so still come in, and then 270 of other current assets. That could be part of a hedge account or other things like that. But other things that we have not recognized as far as tax purposes go. So pretty considerably higher than we were in 2012. And if I just, and I know these numbers, these years are not even, but I wanted 2012 in there because it was a high year, and I wasn't gonna put 2020 in there. So for everyone who's OCD like me, you'll have to forgive me on the year spacings, but I want to just put some history back there. And again, not indexed for inflation, so we'd have some adjustments to make there, but certainly have increased the amount of carryover inventory and that deferred tax liability that would come along with those kinds of things. The other things that's important to think about is we're talking about $870,000 worth of inventory. Even if you're averaging farm or your taxable income of about 78,000, it would take 11 years of zero profitability in order to absorb that $870,000 worth of inventory at that current tax rate, which would be about the top of the 12% bracket. And because that's usually the argument that I hear is if we're talking about getting rid of some of that inventory and recognizing some of that tax, is that we need it for a bad year. But it would take a lot of bad years in order to absorb that kind of inventory level. And if we had 11 bad years in a row, I think we would have bigger problems than our tax situation. So again, just another thought process to do that. And another point, and again, I don't want to get too much into taxes, but I can't take that hat off too far. It just keeps coming back into my thought process. But in order to reduce debt, we have to pay taxes. And that seems like such a backward concept to give some money away in order to reduce debt. But if we're not recognizing taxable income at least higher than those non-farm, non-deductible costs, family living, income taxes, principal payments, especially on land, then depending on what you do with depreciation, maybe principal payments on equipment. Those things are not deductible. If you're not recognizing more than the money that's going out to pay those things, you're increasing your debt, right? Because the only way that you can pay for that then is to increase debt. And so if we're going to reduce debt, we're going to pay taxes, and most likely are having to control family living to do that. All right, then the last one is repayment capacity. I've been talking about these the last couple of years, and I left these slides in just because the numbers, again, just kind of blow my mind. But there's a lesson to be learned in that. So repayment capacity kind of shows us potentially what income is left over to make payments. And so our capacity this last year was 550,000. We have scheduled term debt payments of just about 100. So that left us about 450,000 of additional income that we could use to make principal payments. Okay. And which sounds great, but I also wanted to show this trend line again. Back to 2008, we saw 4 or 5 years in a row with over 100,000 of excess replacement margin. So that would have been money that we could have used to make additional payments, and then profitability fell out. So a lot of money was loaned out in 2008, 2012 to buy equipment, to buy land, banking on that income continuing. The income did not continue. And then we ended up with multiple years of negative replacement margin where we didn't have enough money to even make the payments that we'd already scheduled, and certainly not a lot of margin left over. So even though the replacement margin looks really great this year, we certainly need to be aware of that as we move forward. Okay, don't want to spend too much time on that. Got too many numbers for you. Positive debt decrease for the first time. I haven't seen that in any of the years that I've been working, certainly not to a couple 100,000 point. One thing I do want to point out to that though is that we saw a lot of tax-free loan forgiveness in the PPP program. So if those loans were not forgiven in 2020, it was included in your debt, and they were forgiven in 21, gone away. It would be interesting if I could, and I don't have the ability to pull that out and segment exactly how much that is, but I do think we're probably looking at least some effect of both the PPP program and potentially even the ERC programs that all came out of COVID as helping to reduce that debt. Again, this was a long-term, lots of numbers on there, but again, just showing that decrease. It really was a decrease in just about every type of debt. but certainly that current being the biggest reduction. We've seen actually 2 years in a row of that, which again, I think lends us a lot to a lot of the COVID relief. So, all right, quick, let's talk about some cost of production numbers, because I know everyone's always interested in that. So this is 10-year trend, irrigated corn, all 10-year types. So we've averaged owned, cash rented, and share rented land together. The dark blue line is gross income. The light blue line is expenses. So 14 to 18, they were essentially the same. Kind of an interesting curve of how it reflects on itself there, with 12 and 21 being certainly large margin years. If we dig into some of those expenses, again, I left a few years there in the past. 2013 had been our high cost year until 21. So cost certainly higher in 21. And we'll talk about 22 here because it's obviously not done. But certainly seeing how some of those costs have ebbed and flowed through over the years. But total cost, again, that 944 would be a high number for our averages. If I use that 944 total cost with a long-term average yield of 205, the cost of production on that ends up being about $4.60. Doesn't sound too bad today or the last couple months. But we also do need to add family living and taxes into that. When I do that with an average acre size of about 1,300 acres, I add $60 an acre that we need, of cost that we need to cover. So in order to have a net worth, an even net worth year, we'd be looking at need to sell the corn at $4.90 a bushel. But bigger story probably is what 2022's costs are going to be. And I just rounded some numbers up. Increased seed to fertilizer about 2.5 times. I'm not sure our average is probably going to see that, just because we did have some people who locked in early, lots of different decisions being made there. Increased chemicals. I increased operating and machine costs mostly for fuel, and then increased land rent and a few other costs just a little bit. But that puts us over, well, not even over 1,000, but over almost $1,200 an acre, with some of those input costs that we certainly know are going up. And it doesn't take much driving down the interstate to know that the bigger issue we might have this year is figuring out what that yield might be. So I ran 3 different yield projections. The 245 was where we ended up last year averaging, the 205 being a 20-year average. And then I went down on that to maybe something closer to an insurance guarantee level. And you can quickly see with those $1,200 an acre costs, that cost of production can easily range from $490 to $690 as we're looking out into these projections, which means that even with increased prices, we might have some operations who are just not going to have much of a profit, which makes me think last year the profit was so high because consistently we saw a lot of great incomes. 22, I'm expecting to see a lot more volatility, a lot more range versus those who had hail and those who didn't, and those kinds of things as we go through. So, all right. If we look at soybeans, a little bit more volatile trend line there. Again, 20 and 21 were good years, but some of those years, 14, 15, 17, 19, certainly were not great for soybean production. So it's nice to see that we have that profitability. I didn't dig into cost per acre on soybeans. If you're interested, we can get you some of that data and go through that. But again, in the sake of time, I didn't want to do that. So just a couple of thoughts as we go forward. To me, cost control is going to be really important. Thinking thoughts like just because you've always done it doesn't mean you have to do it is going to be important. Whether that's a fungicide or it's an input or a service that you're buying, we need to be monitoring those things. I've got my slides not sliding right here. tight margins are going to return. I think that's guaranteed. Now, whether that means it's a tight margin at today's prices or a tight margin at today's costs, somehow we will find a way to tighten that back up. So it's important that you know your costs and where you're at, because I can, even though we talk about averages, I know the volatility that goes into those averages is pretty significant. Minimizing income taxes at all costs could be costly to you. So we want to make sure that we're making smart management decisions, not just decisions to minimize tax, besides the fact that that's illegal. And we want to make good decisions. And we can't reduce debt if you don't pay taxes. And it seems like such a backward concept. I totally understand it. But reducing debt, getting your balance sheet in a healthy position when things are good, makes it so much easier to withstand the downturn that we all know is coming. We just don't know when or how long it's going to last for. But what we can do today is get that balance sheet healthy. Tax planning early is going to be super important this year, right? Even if we step back and forget about the input costs rising, that additional carryover grain and feeder livestock inventory that was pushed into this year is likely a lot more than what you're used to having. So that puts your gross income higher than you're used to. We're getting phone calls from producers who are having sizable insurance checks. Crop insurance is deferrable, but it is an all or none election. So if you've got $1 million crop insurance check, we need to handle it in one tax year or the other. That's going to take a little bit of workaround. And as I got on the slide, equipment purchases are not going to maybe be as easy of a solution as what we've had in the past, right? Equipment is harder to find. We can't just get new equipment because we want it. And the rules for having putting equipment on depreciation is that it needs to be ready and available for use, which means if it hasn't been built yet, it is not deductible. And then prepaids, again, we could get back to where we have to watch those rules, make sure it's reasonable, make sure there's a management purpose to it, because if it's just for tax avoidance, it is not a legitimate prepaid expense. So we want to make sure we're getting a discount, something like that. All right, I wanted to leave time for questions. So if you've got questions, please feel free to put that in the chat box down there. And I'm happy to answer whatever I can.
Yeah, thanks, Tina. And as people are taking time to type in any questions that they might have, I just want to remind you to check out the Center for Ag Profitability's website, cap.unl.edu. We'll have a recording of today's webinar up there probably later today. Tina also has a new article coming out on liquidity and more kind of about what she's been talking about here today. You can find there very soon. And Tina, this material, a lot of it is available in the annual Farm Averages book as well, which I mentioned sort of at the top, if you want to mention that.
Yep. So we have this information publicized. You can get a hold of a copy on our website. If you go to nfbi.net, you can find our annual reports there if you're interested in more of that information.
Perfect. And I just put a link in the chat box. If you, before you log off today, can take the time to answer a quick 3-question survey, that really helps us out with your feedback about not only today's webinar, but our series overall, especially if you have ideas for any topics that you would like covered. We do this series every Thursday at noon. And again, you can find that full schedule on our Center for Ag Profitability's website at cap.unl.edu. We'll just do one last call here for questions. I don't see anything, which means, Tina, you covered everything very thoroughly. So thank you.
Or I confused everyone completely. So.
I don't think so. Everybody hung on through the whole thing. So we appreciate that. If you do have questions that that come to mind after you log off today, feel free to get in touch with Tina there. You can see the contact information on your screen. You can also contact us at the Center for Ag Profitability at UNL, and we'd be happy to put you in touch. So seeing no questions, we will go ahead and wrap it up. So Tina, Barrett, thank you very much for the great presentation today. And thank you everybody for attending, and I hope you have a great rest of the week.